Assalamualaikum and good day. We are from Group 1. We present our group project assignment about financial ratio analysis to predict financial distress. Generally, when shareholders decided to make investment in a company, their main intention was to maximize their wealth. By having said that, companies should be more focused on improving their management planning to maintain on top of the industry and to boost their performance. So, this demonstrates as the importance of having the suitable mechanism in place to react to the performance of the company while strengthen investors' confidence. All in all, liquidity, solvency, and profitability ratios were the most important indicators to predict the financial standing of a company. However, the order in which they were important is unclear because almost every research cited a different ratio as the most effective in predicting upcoming issues. Financial ratios are by far the most widely used tools for analyzing, perceiving, and evaluating company financial statement. Moreover, it also used to monitor and evaluate the performance of the companies from time to time. In this context, these ratios are going to highlight the progress and recognize the inconsistencies, anomalies, and uncertainties that need to be investigated further to determine the present and future financial health of the company. The financial ratios are analyzing based on the company's historical conduct, hence are unlikely to be affected through any detailed information in the investigator control. Financial distress usually refers to a situation where the cash inflows of the firm are not sufficient to meet the daily operational expenses. This situation results in the firm's failure to meet its financial commitments in the long term. Furthermore, financial hardship is regarded as over-expensive since it causes companies to act in ways that are detrimental to debtors and non-financial stakeholders.
Assalamualaikum, my name is Aina Syahira binti Ismail and my metric number is 261098. Now I will talk about the importance of financial ratio analysis to predict financial distress. So one of the financial ratio analysis is liquidity ratio. Normally, in business life, some companies might possible to face problem in terms of their financial. However, this can be avoided if a company applying liquidity ratio to detect their financial. A liquidity ratio is one of the mechanisms of financial ratio that is used in order to determine the company's ability to pay their short-term debts obligation. Liquidity ratio is a better way to understand financial performance of a business. It is because the ratio allows them to compare with other companies as well as to track the efficiency of their performance in a business. So there are two types of liquidity ratio, which are current ratio and quick ratio. Current ratio here measure the ability of a company to pay its obligation within a limited amount of time using their current asset. This current ratio here can help in predicting whether the company is having financial distress or not when the number of ratio is high. Meanwhile, quick ratio can be defined as an indicator for a company to pay its current liability without needing to sell their inventory or obtaining other additional financing. The indicator is same with current ratio, where the higher ratio results the company has a good financial health, while the lower ratio is more likely for a company to struggle in paying its debt. So if a company has high liquidity, means they are less exposed to financial distress because they can cover their debt. The summarizations of liquidity ratio is it can help in determining financial distress. However, this type of ratio much focus on short term and not suitable for the long term. So as a conclusion, the liquidity ratio is still useful for a company as an indicator, but it still need to be supported with other types in order to see in detail about their financial health. That's all from me. Next, my group member will explain on the other types of financial ratio. Thank you.
Now I will explain about solvency ratio. A solvency ratio, which is also known as leverage ratio, is a significant indicator used by potential business lender in order to assess an organization's capacity to pay their long-term debt obligations and long-term fixed costs. A solvency ratio is a measure of a company's financial health that determines if its cash flow is sufficient to satisfy its long-term commitments. An unfavorable ratio might suggest that a firm is at risk of defaulting on its debt. Total debt, including current debt, is compared to all equity to calculate this ratio. This ratio can be used to determine the amount of cash supplied by the borrower to the company's owner. In other words, this ratio serves to every ringgit of its capital which is used to collateral for debt. The three most used solvency ratios that can be used to predict the financial distress are debt to asset ratio, the equity ratio, and the debt to equity ratio. The debt to asset ratio, often known as the debt ratio, is a measure of how much an asset's value is financed by debt. It examines the company's balance sheet, taking into account long and short-term debt, as well as the tangible and intangible asset. The higher the ratio, the higher the degree of leverage, and consequently, the higher the risk of investing in this company. Creditors frequently use the ratio to evaluate the amount of debt owned by the firm and its capacity to repay that debt, and whether or not more loans will be granted to the organizations. Investors, on the other hand, utilize the ratio to ensure that the firm is solvent, that it can satisfy the current and future commitment, and that it can create a profit. The second ratio is the equity ratio, which indicates how much of a company's asset has been generated by issuing equity shares rather than taking on debt. The lower the ratio, the more debts a firm has utilized to finance its assets. The ratio serves as a predictor of a company's long-term financial stability. A high equity ratio is preferred by potential investors and creditors because it indicates that a firm is well managed, pays its obligation on time, and is unlikely to go bankrupt. Lenders are unwilling to lend further money to a company with a low equity ratio because the risk of doing so is too great unless they can get collateral to mitigate their risk. The last ratio for solvency ratio is the debt to equity ratio, which is used to evaluate a company's financial leverage and is calculated by dividing a company's total liabilities by its shareholders' equity. In corporate finance, the ratio is crucial statistic. It is a measure of how much a company relies on debt to support its operation rather than entirely own capital. In the case of corporate downturn, it represents the capacity of shareholder equity to satisfy all existing obligations. Since the risks associated with long-term liabilities differ from those connected with short-term debts and payables, investors frequently alter the ratio to focus on long-term debt. From the explanation of this ratio in solvency ratio, we can see that the variable solvency ratio has a significant effect to the business and have the negative relationship with the financial distress. It indicates that a company with a strong solvency will exert influence over creditors since the interest rate will be high, causing the company's debt to grow and the risk of financial hardship is increased. Solvency ratios are able to predict financial distress and have a very strong negative relationship with financial distress.
Next, the important profitability ratio to predict financial distress. It is because this ratio is one of component to calculate bankruptcy index. One of model to compute bankruptcy index is Altman's Z-score. Here the formula. From the formula shows that X2 and X3 is return on asset ROA. The difference between X2 and X3 is that X2 related to return earning, while X3 shows the profit that company earn before interest and tax. By bankruptcy index, we can predict the financial distress of the company. Second, regarding net profit margin, here the formula. From this ratio, it will shows the ability generating net profit from the sales. It means that if the company get positive value of the net profit margin, the company have generate high profit that have the ability to pay debts. From that, we can predict if the company have financial problem or not. About return on asset and return on equity is famous ratio that have been used to predict the financial distress. Here the formula of the ROA. From this ratio, it can shows the earning that generate from the asset. For ROA, here the formula, this ratio shows the earning that generate from shareholder equity. If both ratios shows positive value, it means that company free from financial distress. It is because the company have generate high net income. If have a net income, of course, company no financial problem. Last but not least, for cash return on asset, here the formula. This ratio will show the how much cash that generate from the asset. From this ratio, we can know whether the company have ability to pay debt or not. If the value is positive, it means that company able to pay the debt. If the negative, the company not able to pay the debt. Last one is value of profitability ratio. When the computation of the profitability ratio shows the negative value, it means that company have financial distress. If positive value, it means that financial of company is good condition. So this ratio analysis focus on effectiveness use of the asset. More effective use the asset, more profit can be generated. Important use of the profitability ratio is because this ratio more efficient to predict financial distress in the company. That's all from me.
I would continue explaining on the limitations for using financial ratio analysis to predict financial distress. First, the analysis is based on historical information. Hence, the indication of possible financial distress identified in this year may not accurately predict the financial distress in future when there are other factors causing the company's financial performance to turn good in the following years. Second, limited information would be obtained if the analysis is not used for comparison and with a combination of several financial ratios. More useful information can be obtained for the prediction of financial distress when the ratios are being compared over time or with different entities. Thirdly, accuracy will be affected by changes in accounting policies, accounting estimates, and correction of errors as it affects the comparability of those financial information. Fourth, financial ratio analysis may not be useful for predicting financial distress if the company applies earnings management techniques or manipulates the financial results fraudulently to show better financial results. Next, there are some recommendations on the use of financial ratio analysis for predicting financial distress. First, the financial ratio analysis is recommended to be used as a good management tool as it provides danger signals to the management on possible financial distress where suitable preventive or corrective measures can be planned and implemented immediately before it is too late. Besides, it is also recommended to apply the analysis to predict financial distress of suppliers or debtors companies. Contingency plan can then be prepared earlier to react with possible problems due to their financial distress, such as unavailability of raw materials and default of payments. Other than that, it is recommended that investors should use the financial ratio analysis to predict financial distress of companies to avoid investing in risky companies.
In conclusion, financial ratio analysis can be used by the companies to predict their financial distress, especially from liquidity, solvency, and profitability ratio analysis perspective. Indeed, financial analysis is a method to keep track of the performance and financial standing of the business. If the financial analysis reveals that the company's finance are in trouble, then immediate action may be done. Hence, it keeps the company on track to improve performance and prevent insolvency. That's all from us. Thank you.